Welcome to our update on the FASB's project on clarifying the definition of a business. Today we'll take a few minutes to discuss the FASB's current status on this project and the proposed framework to determine whether a set of assets and activities is a business, which would narrow the current definition of a business. My name is Casey Miles. Today I'm joined by my colleague Tony Gahn. We are both senior managers in KPMG's Department of Professional Practice. Tony, maybe we can start off today with you giving us a quick overview of the project and why the FASB decided to add it to their agenda.
Sure, Casey. The FASB added this project to their agenda back in 2013. It got added because stakeholders had indicated that the definition of a business in Topic 805, business combinations, is applied too broadly and results in many transactions qualifying as a business that seem more like asset acquisitions. There have also been concerns that applying the current definition of a business to transactions can be difficult and costly. The board has taken the approach of splitting this project into three phases. The first phase, which is what we're discussing on this update, addresses the concerns I just mentioned. The second phase, which has interdependency with Phase 1, addresses the scope of subtopic 610-20 and clarifies the reference to in-substance non-financial assets and the guidance on partial sales or transfers of assets within the scope of subtopic 610-20 and the corresponding accounting for retained interest in those assets. We discussed the topic in more detail in another accounting update. In the third phase of the project, the board will determine whether there are differences in the acquisition and derecognition guidance for assets and businesses and if those differences can be aligned. The FASB issued their proposed ASU on clarifying the definition of a business in late 2015 and completed the comment period in January of this year. Casey, at this point, I think I'll hand it off to you and maybe you can walk us through the framework of the proposed ASU.
Thanks, Tony. Similar to the definition of a business in current GAAP, a business consists of inputs and processes applied to those inputs that have the ability to create outputs. However, the definition of a business in the proposed ASU differs in several respects. The proposed ASU has a threshold test that's labeled with A on this slide. That test says that if substantially all the fair value of the gross assets acquired is concentrated in a single tangible or identifiable intangible asset or group of similar tangible or intangible assets, the set is not a business. So when this threshold is met, the set would not be a business, and an entity would not evaluate the rest of the implementation guidance to determine whether the set includes a substantive process. The threshold is intended to act like a screen, and the board's intent is to make the analysis practical, and the criteria are intended to weigh the need for practicality with the risk that too many items are grouped together to avoid being considered a business. The proposed ASU includes guidance that certain items, such as intangible and tangible assets, are not similar and cannot be grouped into a single asset to avoid inappropriate groupings of assets. If a set doesn't pass the threshold test, then an entity needs to evaluate the set under the guidance labeled as B on this slide. An entity would evaluate whether a substantive process exists by first determining if a set has outputs or not. Under the proposed ASU, if a set has outputs, for example, if there's a continuation of revenues before and after the transaction, an entity would conclude a set is a business if the set includes an organized workforce that is critical to the ability to create outputs, if there are significant barriers to replacing the acquired process, or if the acquired process or group of acquired processes together is unique or scarce. The proposed ASU states that when a set does not have outputs, for example, an early stage company that has not generated revenues, the acquired set should include an organized workforce that is critical to the ability to develop or convert the acquired inputs or inputs into outputs.
So, Casey, the definition here certainly seems to provide a more structured framework for thinking about the definition of a business than the current model. I'm a bit curious to see how the threshold test works in practice across different entities. Do we have any sense, do we think the threshold test is going to cause entities more work because now they have two analyses to perform?
So the FASB stated in their basis for conclusions that they don't anticipate the threshold always being a quantitative test. For a lot of transactions, it's going to be obvious that all of the fair value of the set isn't concentrated in a single identifiable asset, and the FASB said that entities could perform a qualitative analysis in those instances. Tony, I just gave a lot of information on what the proposed standard says. Maybe you can walk through the fact pattern for our example, and it'll help us see how all this fits together.
Yeah, I think that makes sense. So let's assume that a REIT purchases all of the outstanding shares of a real estate company from the seller. The set includes a multi-tenant office park with 6 fully leased 10-story office buildings. The seller has historically managed the property centrally with its own employees. The identifiable assets that the REIT has acquired includes land, building, and in-place leases. They've also assumed some vendor contracts for cleaning and security, but none of the employees from real estate company are being acquired because the REIT plans to use its own employees and property management. In this example, the entity would group the buildings as they represent the same major class of tangible asset. But Casey, as you mentioned before, for purposes of the test in A, entities won't be able to combine the intangible and tangible assets as similar. And in this example, the fair value of the in-place lease intangible asset is significant. Because it is significant, SET would fail the first threshold test. So this is one of the examples of situations that are likely to occur where the qualitative analysis comes into play and entities don't really need to look at the fair value of every single asset to determine if one of them or a group of similar assets has substantially all of the fair value concentrated in it. So when we look to the analysis in B, we know that this set has outputs since the multi-tenant office park is fully leased. Because there are outputs, the set would need an organized workforce with skills, knowledge, or experience critical to continue producing outputs, a process that cannot be replaced without significant cost, effort, or delay, or a process that is considered unique or scarce. In this case, the only processes acquired are the cleaning and security contracts. Neither one of those would be considered unique or scarce, and there are plenty of companies that REIT could hire to perform these processes, so they can easily be replaced.
Thanks, Tony. At the board's August 24th meeting, some key decisions were made related to feedback received in the comment letter process. The board affirmed several of its previous decisions and made further clarifications to the proposed ASU specific to the threshold test, as well as the evaluation of whether a set includes a substantive process. In applying the threshold test, the board clarified that a single identifiable asset includes any asset that could be recognized and measured as a single identifiable asset under Topic 805 for financial reporting purposes, with two exceptions. First, an entity could consider a tangible asset that is attached to and cannot be physically removed and used separately from other tangible assets without incurring significant cost, significant diminution in utility, or fair value to either asset as a single identifiable asset. This would include an intangible asset that represents the right to use a tangible asset. Secondly, in-place lease intangible assets, including favorable or unfavorable lease assets and liabilities and related real estate assets, should be considered a single asset. This decision would likely change how we thought about the example that we walked through a few slides back. Rather than the fair value of the gross assets not being concentrated in the leases or tangible assets, the leases would be considered a single asset for purposes of the threshold test, and we would reach the conclusion that the set was not a business by applying the threshold test. The board also decided that deferred tax assets and the effect of deferred tax liabilities should be excluded from the gross assets acquired, and that identifiable assets within the same major asset class that have significantly different risk characteristics should not be considered similar assets. With regards to what constitutes a substantive process, the board affirmed its decision that to be accounted for as a business at a minimum, the set must include an input and a substantive process that together significantly contribute to the ability to create outputs. The board also decided that when a set does not have outputs, a set would need to include employees that perform a substantive process. With regards to transition, the proposed ASU that was issued in November 2015 would require an entity to apply the guidance prospectively to any transactions that occur on or after the effective date. Part of the rationale in having prospective application is that it will provide consistency between financial statements of entities. As far as next steps, the board has redeliberated the comments it received on the proposed ASU and will likely redeliberate comments on the proposed ASU to clarify the scope of asset derecognition guidance and accounting for partial sales of non-financial assets prior to finalizing the definition of a business due to the interdependency of these projects.
Thanks, Casey. That's all the time we've got today. We sure hope the information provided gives you some insight into the FASB's project on defining a business and some of the changes that we will likely see as a result of the proposed ASU. Thanks for joining us.